Welcome to this month's Market Update. I'm joined today by KC Lowe, Senior Consultant with Frontier Advisors. Hi there, KC.
Hi, Wayne.
Well, as we start a new financial year, often this is the time to reflect back on the year that's just passed. So let's start today with a bit of a review on the 2021-22 financial year. KC, step us through market performance across that period, please.
Thanks, Wayne. So, a lot has happened over the last 12 months. If you think back, we started off the financial year hoping the pandemic is behind us, but then we ended the financial year with a war in Ukraine, and we have central banks around the world raising interest rates at quite a rapid pace now. But the consistent theme throughout the last 12 months has been inflation. So we started the financial year with central banks thinking that inflation was going to be more temporary, but then we ended the financial year with most central banks thinking that inflation will be staying around for quite a while, which has forced them to raise interest rates now. So as a result of all these factors, we're seeing quite a lot of volatility in financial markets. In particular, equity markets have performed quite poorly in the last 12 months, especially in the second half of the financial year. Emerging market equities in particular has performed the worst out of all the regions, and that's primarily been driven by Chinese equities because investors have been concerned around regulatory actions there, not just against the technology companies, but across the property sector and also private education firms. And it hasn't been helped that China has maintained their zero COVID policy, so there's still concerns around what that means for economic activity there. If we look at developed market equities, which has also done negatively, but not as badly as emerging markets, we've seen US equities in developed markets perform pretty poorly, and that's because of the larger exposure there to technology stocks, where valuations there were pretty high before we saw the falls in market, and that they've tended to be more sensitive to increases in interest rates. But locally, the Australian stock market has done pretty well, at least relative to other markets, although the performance still has been negative. And the main reason for that has been our larger exposure to the resource sector, which has benefited from higher commodity prices over the last 12 months. But looking forward though, with the slowdown in the housing market, there's a risk to Australian banks, which do comprise quite a large part of the Australian stock market. So that's one area to be mindful of there. So that's on equities. It's been a negative year in that market. And historically, the bond market has been the opposite when equity markets has fallen. So bond tends to do well when equities are falling, but not this year. And that's because high inflation and rising interest rates tend to be also negative for bonds too. So we've seen both equity markets and bond markets deliver negative returns this financial year. Although cash has provided capital preservation in the last 12 months, you have to keep in mind though, once you account for inflation, you are still losing purchasing power on cash too. And probably the last asset class I'll touch on is just on currencies. And that's probably one positive we can take away from it is that although the Australian dollar falling has made imports and overseas holidays more expensive, the upside is that it has offset some of that negative return from international investments.
So some really significant themes and events around the globe, many with a huge humanitarian cost. Of course, they flow through to investment markets, and that in turn flows through to the superannuation accounts of many millions of Australians. So, KC, how have superannuation funds been impacted in terms of performance of funds over the year?
So from a superannuation perspective, it has been a tough year. So the expectation is that most super funds will have had a negative return for the last financial year, but not as negative as what we've seen in the stock market, which really showcases the importance of having a diversified portfolio as these super funds will have. But it's also important to remember that markets can be volatile in the short run, such as what we've seen in the last year. But when you're building long-term wealth for retirement, you need to focus on the long-term view in terms of taking investment risk. So, we are talking about the one-year performance here, but superannuation funds are focused on the long term. And when we're working with our clients for setting their investment strategy, we tend to focus at least at the 10-year investment horizon or even beyond that. So not just on the 1 year. No one likes it, but we have to accept that occasionally we'll get negative return years every now and again, such as what we have this year. But you have to keep in mind, over the long term, superannuation funds have delivered quite reasonable or quite positive returns for all their members. So if you look at the average superannuation fund, they've generated around 6% per year over the last 5 years, despite all the volatility we've seen. And if you look over the longer term, over 10 years, the average superannuation funds delivered around 8% per year. So, pretty solid returns.
Correct, Casey. Very pleasing, and in fact, quite strong returns over the longer term periods. That's right. So looking forward now, in particular, let's just talk about the Reserve Bank. There's a lot of commentary and not always a lot of complimentary commentary on the actions of the Reserve Bank. They've got a big task at hand. What have been some of their more recent moves, Casey?
So, continuing the discussions we've had over the last few months on these videos, the trend is still up for interest rates and cash rates around the world. And that hasn't changed for the Reserve Bank of Australia in the July meeting. So they've increased the cash rate again by 0.5%. So the cash rate now is at 1.35%, which is quite extraordinary when you think back. At the start of the year, the cash rate was still at 0.1%. And the expectation from the Reserve Bank of Australia is that they'll continue to hike interest rates over the coming months. In terms of how quickly or the size of the interest rate increases, they continue to say that will be driven by both the inflation outlook, but also by the labor market outlook. The RBA's own forecast is that inflation will likely peak later this year, and then it'll start to moderate back towards that 2 to 3% range, which the Reserve Bank targets. In terms of market expectations, though, the market is expecting the cash rate to continue to increase and to end the year at 3%. So a lot more rate hikes expected by the market.
That's right. So a range of really interesting levers being pulled by all sorts of different factors. We look forward to watching how that unfolds during the course of the year, Casey. Thanks for your update today. And thanks for watching this month's Market Update.